Good afternoon, everyone. Welcome to today's daily recap. It is Friday, the 13th, and I don't want to, I don't want to spread fear on Friday the 13th. Well, why would I ever do that? But the market clearly was spooked, and this week you're looking at a weekly chart of the spiders, the SPY. You can see after a 6-week snapback from here to here, where we basically rallied back into a strong area of resistance. The market again proving that this level is a level that has become over time very, very substantial. As we zoom out here on this chart, you can see that we spent the better of 10 months building in this area to only then break down as we did here in August. To get this corrective type of price action back into resistance, where sellers again come back in. And this market has been dominated by volatility. You can see going back to August of 2014, just the wild gyrations that this market has had, in a year type of time span. And it's tough for traders when you have a non-directional market. Non-directional in the sense of there is no trend in play here. This is a trendless environment. This is a volatile environment. You can even see that trend defined here by this red line, which is the 21 EMA on the weekly. The difference in the type of market composure when the 21 is running at a 45-degree angle from left to right, versus what's happening over here, and possibly into flattening out over the next couple of weeks. That's a market that is ultimately defined with as a trendless market, a sideways type of environment. As we look at the daily, I'm going to go back here. A sideways trend can result in trading environments that we saw for the better part of this year, from February, from January, February, all the way through. We broke in August. This 21 EMA basically, ran sideways, and you can see how price, trades in that type of environment, right? Very choppy, non-directional. At some point, it resolves itself. But as we look at the weekly, are we setting up for that type of environment, which could spell that this market will be, very, very tight and choppy for many, many months to come. We'll see. Again, time will tell. There's no real way for me to look into my crystal ball and tell you what will happen. All I can tell you is what the possibilities are and how to think about, how you're going to approach those scenarios. So, the market turns down this week.
With Parks.
Now what, right? Is this going to get continuation? Are we going to come and fill this open gap right here? There's not much in terms of support until, maybe we get down into this lower area down here. So, you really need to proceed with caution. Every time the market has, traded on highs or lows, it creates a certain type of feeling. So what I mean by that is, when we have a strong move like we did here to the downside, what happens is you get a bounce, and then traders immediately look to short that bounce, and that's where problems have arisen, both long and short, because you're not getting follow through. So now you've had this move back to highs. We pull back. Traders are going to say, okay, I want to buy this pullback, because they're looking for that follow through or that trend continuation. And that's where this market has proven to be so difficult, is that buying pullbacks of recent strength has not proven to be a profitable strategy by and large as we look at the bigger picture. So don't be fooled. This can certainly, again, continue to be a very, very elusive trade all the way back down and continue to chop around. So you really need to approach the market much more strategically, tactfully, and probably live on smaller time frames. Again, here's the daily, and as I zoom in, you got your recent break to the downside, probably going to hold this area. Could be an area for a little bit of a short-term bounce. But if this bounce doesn't amount to much, if in the event we hold this area, if it doesn't amount to much, well, then that could be signs that we want to, like I said, fill this open gap. The market's been very, very elusive in terms of gaps that ultimately turn and get filled. So I would say a grain of salt. That's how we're going to approach this market. It also, if you look under the hood, and you look at some of the sectors, what did we see this week in retail? Retail is not a healthy place. Here's the XRT. And as we look at the weekly, this is a sector that, while the market traded back to highs, you didn't see really much in terms of any buyers stepping into retail. And in one big swoop, the second that market turns down, you have that relative weakness here, boom, you get that big red, down bar. So going into the holiday season, probably not the ideal scenario for retailers. And Target today, I was watching Target, one of the names that has been holding up relatively well, but turning down pretty aggressively this week. Here's a weekly. Let me give you the daily. So I would keep an eye on that retail sector, as it's not a new scenario, but a scenario that continues to evolve, and it does not look good for retail. The only area that I would say we've seen enthusiasm, and here's the NASDAQ. Here's the NASDAQ 100. The NASDAQ really the only place that I saw new highs. And you can see here, the NASDAQ making new highs. But other areas, the Russell, and I'll show you the IWM, these are not new situations, so this is probably not new speak to you. But the Russell, Russell pretty weak. Russell really didn't see much in terms of buying or any enthusiasm to the upside. So there's a lot of mixed bags in here, and you really got to pick and choose your battles. There are some areas of this market, if not quite a bit, that are relatively weak and have acted relatively weak, given the nature of what the market has done over the last, 6 weeks, 5, 6, 7 weeks. So, without getting specific into any one thing, and you can basically look anywhere. Apple, trading lower today. IBM has been a story that, not many have been talking about, but breaking down pretty substantially, for quite some time. So as the markets continue to be volatile, there are some stocks that have been breaking down and stocks that are, I think, worth mentioning. The area that I think has been probably one of the more difficult areas to trade is biotech. And biotech, after peaking, and here's the IBB, back here, again, has fallen prey to some near-term volatility. And even today, you're seeing this is a weekly chart, is what I'm showing you. Notice all these tails, right? Every down bar, basically, which basically means that every time we come down, we snap back up. And even on the upside, every time we go up, we snap back down, and even this week. So look at the weekly chart and how volatile this has really been. And as I show you the daily, it'll give you a little more sense of that short-term back and forth price action. You can see it pretty clearly here, right? It doesn't look like much, but it's constantly back and forth, right? Up and down, up and down, up and down. And that's usually not a sign of a healthy market when you have lots of volatility. I also would say, as far as biotech goes, lower highs, in place. So should we get in gear and this index start to break down, that could be, your real, I'd say your real barometer for potential trouble here, as it looks like this is, kind of bear flagging here overall. So keep your eye out for biotechs, because I think that could be the real key for, a market that could potentially turn back down again. So like I've said, and this market's been elusive. I will be the first one to tell you that there have been pockets of this volatility as we look at the spiders that I have nailed on the head, and there have been pockets where I've just gotten it wrong. I definitely was in the camp in terms of technicals that once we saw this tail right here, that this would follow through. And that has been the short-sightedness of many, myself included, where it's natural, like I said, to want to buy up at highs, but in this market, you almost have to think counterintuitively. And the best thing this market could do would be to stabilize somewhere in this area and begin to turn back up. But just kind of keep an open mind about it. But if biotech starts to break down and retail starts to break down, and you start to see some big cap technology not follow through, the one that looked kind of suspect today, and many look suspect today, but the two that I was kind of keying in on, Google. Let's see here, Google. Google, bit of a failed breakout, and let me show you what I mean. You had this, earnings gap, and then it took out this high, right? And then we sat up here for a couple of days, but then failing to hold highs is essentially a failed breakout. Failed breakouts, just like failed breakdowns, can lead to sharp and potent reversals. You don't have a lot of support, until maybe you fill this gap down here. So keep your eye on some of these things going into next week. Netflix, another name that I think worth noting, only because Netflix obviously has been a high beta, momentum-driven stock. But as the market climbed over the last couple of weeks, this stock really failed to make new highs. You can see it had multiple touches here along that 116 before finally, coming off pretty hard yesterday and today. Really not much in terms of support until down here. So, I wouldn't recommend it for anything more than just cash flow or short-term alpha generation type of trade, but certainly one that for the first time I've seen some relative weakness there. So, going into next week, I would, I'd remain cautious. Doesn't mean we're not going to see, pockets of up. But like I said, I think cautious at best, as the red flags are certainly waving up here. Failure, to make new highs or a failure for some of these to get any follow through. The Russell, definitely worth watching as these things, clearly diverging, and they're not trading, you're not seeing that strength anywhere outside of maybe the NASDAQ 100, which, sort of led us higher over the last couple of weeks. So with that, I bid everybody a wonderful weekend, and we'll talk next week. Enjoy, everybody.